Okay, well, I'm going to do a presentation on the US dollar as a reserve currency, and then I intend to look at where I think that the US dollar will head over the coming weeks and months. So I'd imagine most of you don't know me. So I'm Bijoy Kar. I'm a technical strategist here at MIG Bank. I'm a mathematician by education with a BSc and MSc in applied mathematics. I'm also a fully qualified CFA charter holder. And prior to working here at MIG, I've got 14 years experience predominantly in foreign exchange in the bond markets. So as we go along, if you've got any questions, just ask. So the reason for this presentation really is that quite often, but over the last weeks and months, one of the biggest questions out there in the FX markets is whether or not the US dollar will remain the world's reserve currency. And what I find is that this question always seems to crop up when the US dollar has been in a period of steady to rapid devaluation and fears of a dollar crisis become more widespread. It's my opinion that these fears are really driven by the high current account deficit in the United States and the weak financial position with a large amount of government debt outstanding. I think also the housing market crash that took place as a result of the credit crisis has had a big impact on the US consumer, and this warns of a period of austerity ahead. However, I think it's precisely this period of austerity that could help to turn around the US current account deficit. Another thing that is quite often ignored is that the US are importing more and more oil as opposed to using their own reserves. And I think this is a major factor behind this stubborn nature of the current account deficit. So if you're just looking at the numbers, you might be led to believe that the current account deficit is getting worse and worse, or at least not improving. But actually, part of the reason is because of the US importing so much oil. So as the US dollar depreciates, the price of oil will rise, or it tends to rise. So it costs more for the US to import oil, and so more dollars flow out of the US, and hence the current account deficit is affected negatively. I think one of the main reasons that the US dollar is the current reserve currency of the world is simply that it's a major trading partner to most of the world's large economies. And by that, I mean, if you were to look at trade versus Germany versus United Kingdom, Canada, Mexico, India, perhaps Russia, you'd see that the US is probably within the top 10 trading partners of all of those countries. So by sheer flow of trade alone, the US is transferring dollars to those nations with surpluses. So all of the surplus nations are just naturally going to amass US dollars. We mustn't forget that over a lengthy period of time, it's possible for a reserve currency to lose its status. This happened with the British pound prior to Bretton Woods. However, I think a process like that will actually take quite a while to pan out. And the most important thing to realize is that if the US dollar is to lose its reserve status, then there must be another currency to take its place. And so we need to consider what the conditions are for an alternative currency to take place of the US dollar. And I'm going to look at some of those conditions on the next slide. So to be a reserve currency, some of the requirements are you need a deep, stable and well-developed government bond market. You need financial markets free of manipulation. A wide variety of financial offerings in your marketplace with substantial liquidity. And I think one of the most important things is you need a respected and trusted central bank with a clear mandate for financial stability or low inflation. And I think a small point as well is that a degree of military strength to safeguard the political system within the nation is desirable. So, basically, if we take into consideration all of those the above conditions that are required to be a reserve currency, we would put forward that the US dollar is really the only currency that can actually act as a reserve currency, simply because there is no viable alternative. Quite often the euro is put forward as an alternative, but I think the main reason that this is just not feasible is that this is a trading region. There is not a common means of tax collection, and there is some very, very serious internal imbalances between the core and the periphery, which I believe will just get worse, as we're seeing with Greece, Spain, Portugal, and perhaps Italy and Belgium. The Chinese renminbi, now that's often cited as an alternative, but the issue with the Chinese renminbi is that it actually possesses virtually none of the characteristics of a reserve currency. And I think a question has just come up here, somebody asking about the Swiss franc. I think the Swiss franc is, for me, the main reason why the Swiss franc is not really a potential reserve currency is it just doesn't have a deep enough government bond market. There just isn't enough Swiss-denominated government debt outstanding simply for the reserve managers to invest in. Sterling, I think the sterling is in a worse position than the US dollar in terms of deficits, etc., and fiscal position. Okay, so going back to the Chinese renminbi, I think one of the major points about the Chinese renminbi is it's not free floating, and we mustn't forget this is actually a communist country. It's a centrally governed country, so that even the financial markets ultimately they're not free. So the conclusion is that just through sheer momentum of trade and a lack of a viable alternative, the US dollar is at present the only possible reserve currency for the world, and we actually see the US dollar maintaining that status for the foreseeable future. There just isn't a viable alternative. Okay, so the next thing I'd like to look at now we've sort of covered the US dollar, and in my opinion have come to the conclusion that it's not we're not about to enter into a dollar crisis. I'd like to look at the correlation between the S&P 500 cash index and the US dollar index. Now, this correlation is currently at about 0.5, minus 0.5, rounded to the nearest 0.1. And the best way to interpret this correlation is to look at the linear regression between the two variables, if you like, the S&P 500 cash index and the US dollar index. And we can do that by looking at a slide provided by Bloomberg. So this is the next slide. So on here, on the x-axis at the bottom, we've got the return of the dollar index. On the with the y-axis, we have the return of the S&P, and you can see that there is a linear relationship between the two, and it's negative. And we have various statistics here on the right-hand side of the screen. So what we can conclude from this is that we can use movements in the US dollar to explain some of the movement in the S&P 500 index. Now, there is a logic to this. It's not just what's termed a spurious correlation. So these two things are actually linked. And we can explain this through what's called a causal connection between the two variables. So we just want to recall here that the correlation is negative. It's negative 0.5. So that means as the US dollar strengthens, the S&P 500 should tend to decline, or it should have downwards pressure exerted on it. Now, we know that a large proportion of the S&P 500's earnings are derived externally to the United States. Companies like Caterpillar, Hewlett-Packard, etc., they're going to get large proportions of their income from external to the United States. So the key here is that as the US dollar weakens, the cash flows that are generated externally, they will be translated back into US dollars at more and more favorable rates. So if the US dollar is actually depreciating, if you take your British pounds that you've earned and bring them back into the US, you'll find that your British pounds will obviously buy you more US dollars if the US dollar is depreciating. So that will increase the earnings. Similarly, if you just look at it the other way round, that as the US dollar strengthens, these external cash flows will be, when they're translated back, they will be smaller, all else equal. So in periods when the US dollar is weakening, you will tend to find that there is support, if you like, for the S&P 500, and when the US dollar is strengthening, there should be downwards pressure exerted on the S&P 500. And just the next bullet point there, the second bullet point, is just it's quite a intuitive statement there, that as investors sell the S&P 500 and return their proceeds to their home currency, that should also put downside pressure on the US dollar as well. So we can actually look at this relationship by taking a look at the chart of the S&P 500 and the dollar index right below it. And what we'll find is, if we take a look here, is that generally speaking, as the US dollar strengthens, there tends to be a downside pressure on the S&P 500, and also as the S&P 500 comes off, you will tend to find that the dollar will experience a degree of support as well. So you can see here this phase here is the US dollar actually weakening, and you can see the S&P 500 is generally rising. You have this area here where the dollar was strengthening, S&P 500 came off. Similarly here, the US dollar was weakening and the S&P 500 was going up. And in this period here, although the S&P 500 didn't actually collapse or go down, it certainly didn't go up. There was downside pressure exerted. So again, that's just really something to note. Something else that is quite important here on the S&P 500 chart is that we have reached a major extension target at 1337.63. So if I go back to the slide, we're looking roughly up here. This actually equates to a major extension target, and it is the 161.8 extension of the vertical distance from 666.79 to 956.23, extended up from 869.32. That takes us all the way up to this region here. So for me, the fact that it's reached this extension target suggests that there is scope for a pullback. So the next thing that we'd like to look at is the dollar index, just to see if we can gauge where the dollar index might be going. So what we're looking at here is a daily candlestick chart of the dollar index. The main thing to note here is this falling wedge that I've highlighted in the lower right hand corner. We've seen a breakout of the wedge which failed to hold. The market has pushed back up again, and we've broken back over this 75.810 level. So this to me is a confirmed false break lower out of a falling wedge, and that typically is a bullish signal. So for me, I'm seeing a bullish signal here for the US dollar. Now if we look at the US dollar index on a monthly time frame, again on a candlestick chart, we can also see that there is a what's called a symmetric correction from this 89 spot 624 high. So you can see this here is a symmetric correction, and by that I mean if we take the vertical distance between this high here, the 89 spot 624, to the 74 spot 170 low, and we project it down from 88 spot 708, we're pretty much getting down to this region here. So we've actually completed a corrective phase in my view, and we're also reaching levels, as you can see, that have been seen back in 2008, and we've broken back below this 2010 level here. So these are major levels in the dollar index. So I think there is scope for some demand to manifest around here. So I just highlight these points on this particular slide here. So both of those charts that we just looked at suggest that there is scope for a recovery and a period of dollar strength. So if we do actually see some dollar strength manifesting itself in the markets, we can also expect some downwards pressure to be exerted on the S&P 500 index going forward. And that's, we need to take that into consideration, that we've also seen that the S&P 500 has met a major extension target as well. So putting this all together, the US dollar, I think, will remain the world's reserve currency, and over the coming weeks and months, I would actually favor a reversal of fortune for the dollar as global growth begins to slow, or at least to moderate. So we've just got a question. So does this mean that the euro will go down? I think that this isn't something that's going to manifest itself literally in the next few hours or days. We've been looking at daily and monthly charts, but yes, I do think that we could see a reversal of fortune for the dollar, and so you could see some downside pressure on the euro certainly over the coming weeks and months. And one thing that I think that this is the last point here that I bring up is quite important for me, that the majority of the world's debt outstanding is still denominated in US dollars. So if we get another credit contractionary period, as happened in 2007 to 2008, then you will actually witness a very large demand for US dollars. Whether or not it makes sense or not is immaterial. It's just simply driven by the fact that so much debt is denominated in dollars. I think we've got another question here. It's, do you think the euro has a long-term future? It depends on what your definition of long-term is, but I don't think the euro could, personally, in 5 to 10 years, I doubt the euro will exist in the same form that it does today. Another question, do you have a target price for the euro? I haven't actually examined the euro charts in order to provide a target. However, I think that we could head back as a minimum down to the 120s, 125, 126 level. I think there's no doubt that Greece, the issues in Greece aren't going to go away. Greece will eventually default and probably will exit. It seems from the evidence that Greece would be better off outside of the euro, and perhaps that's what will happen. So they may exit the euro, and that can work two ways. Initially, the euro may weaken as other countries decide to leave the euro, but then eventually, if you have a strong core, the euro could start to strengthen again. But I think the main thing that I'm looking at here actually is that as risk is taken off, if you do see a weakness manifesting in S&P 500 and other equity indices, you will find that it automatically creates a demand for US dollars because you get a deleveraging cycle that starts to begin, and in every deleveraging cycle, the demand for dollars becomes higher, just simply because there's so much dollar-denominated debt out there. Do I think that the US will eventually have to default also? No, I don't. But I think that they will just go through a period of incredible austerity. I don't think that the US is in the same position as Greece, let's put it that way. If they continue to behave in the ways that they have over the last 2 to 3 years, then perhaps. But I must admit, in examining the balance sheet, if you like, of these countries, I'm certainly no expert, but I don't think that the US is Greece. Let's put it that way. They're very different. Sort of. What do we have here? We've got, they will just print more dollars. So if the US dollar strengthens, do you expect gold, oil, and other commodities to fall in value? Yeah, I guess because they're all denominated in US dollars, I think that the majority of commodities should also experience some downside pressure, but then you have to consider the different scenarios that might pan out. So you've got some risk markets coming off, like the S&P 500. Let's say if this does actually take place, then there must actually be a safe haven, or you'd hope that there is one safe haven, and there is a possibility that gold acts as that safe haven. So despite the fact that perhaps other commodities are coming off, like gold and like oil, natural gas, copper, etc., maybe gold maintains some of its value. But I think the majority of commodities are likely to experience some downside pressure if we see this de-risking, basically. So we've got another question here. So actually, the S&P strength is resulting in the dollar fall, or the dollar fall that is resulting in S&P strength. I mean, you can, as we've shown in the presentation, you can argue that as the dollar begins to strengthen, this puts automatically a downside pressure on the earnings of some of the constituents, or many of the constituents of the S&P 500, and so automatically the dollar should begin to affect the S&P 500. So I mean that's natural, and also, as you say, as the S&P falls, let's just say if the S&P falls, all else being equal, then also this equates to a de-risking exercise, if you like. And so also, because of the fact that so much debt is denominated in US dollars, if it does turn into a credit contractionary cycle, then there will also be a demand for dollars. So yes, I think you can look at it both ways. So that's what I write in the first two bullet points here, that as you get a move out of risky assets, it can actually create a self-reinforcing demand for dollars. So and that's exactly what happened back in 2007 and 2008, as credit was removed from the system, if you like. You had this contractionary period in credit, that the dollar automatically rose, and it was quite vicious, simply because those people who had lent out in dollars just demanded their dollars back. One thing I would stress here, though, is that any strength in the dollar would be viewed as corrective to the longer-term downtrend. So if we go back to the slide here, I think we need a break back over this 89.624 to really suggest that we're in a dollar bull market, if you like. But I do expect a correction anyway to the upside. So yeah, 89.624 is quite important on the dollar index. That's it. Oops. Any questions? Can I just get the present? I'll just need to get the presentation up. So I need to go to the end. What will be our trigger? So if we look here, I suppose to be safe, you could. It depends on whether you like to trade momentum or not, but you could buy a break above this high here, just over 76 on the dollar index. If I look at the shorter term structure of this leg from 72.696 up to this just over 76, I think that there is actually another leg higher anyway. Even if it just tests this 200-day moving average, although I expect it to go further than this, just because of my expectations of what might happen in the S&P 500. So if you like to trade momentum, you could trade a break over here. Alternatively, even around current levels, if you placed a stop under this low, I think current region is a reasonable place to try getting longer US dollars. Any other questions? Thank you very much.